This is Tom Hewlick. I'm the CEO and managing partner for Strategy Asset Managers. We're here in Pasadena today. Joe Traba, our senior portfolio manager, and Alex Hagstrom are joining me to address where we are with our market outlook. How are things going? What do we need to be doing, thinking, and then how should we respond to data that we get on a daily basis? The S&P 500 had a nice 2.45% rally today. That gives us a chance to really sit aside and catch our breath for all the negative information that's been out there. We're going to answer questions about where interest rates are ultimately heading. If the war in Ukraine is going to continue on, what should we be expecting? Are we going into a recession or are we in a recession? And how long do you think this correction is going to last? And what sectors do you think we will lead us into the recession? I would like to go over a couple of data points that are relevant right now that we've been talking about on our morning research calls. Really, Joe has been talking about this for months, about resetting expectations for what we've experienced over the last 10 years and kind of the easy money that's been made by investing in equities. Well, that obviously changed at the end of the year and starting in 2022 when we experienced the where we are today, kind of this downward leg of the market, and now we're off nearly 20%. We're definitely in bear market territory after today's rally, which could be a bear market bounce. We're 2.5% higher. Alex will probably give us up-to-date numbers of where we are exactly, but what does this really mean for us? And what should you be doing to prepare for the next 6 months and possibly even a year or even the next 2 years? What's our outlook going to be? Is the market oversold at this point? Is this a time for us to go in and start buying things, or should we be extremely defensive? We're having conversations like this constantly, but definitely consumer sentiment has been at its lowest point in a long time. Is that correct, Joe?
That is correct. I mean, looking at some of the sentiment numbers, and this does control short-term price movements. You're seeing levels, again, that reached the 2008 meltdown, and at a lot of levels where, you are seeing the worst has already been priced in to the market. And I think that's one big key that we have to look at is how much negative sentiment is out there. And it's not just forward-looking. This is stuff a lot of it is in the back rearview mirror. Some of the things that we've spoken about, it's a lot of fear that's out there, and it's the fear of the unknown. We are seeing inflation ratchet much higher than expected, and that is forcing the Fed to raise rates much faster than expected. This is, again, a resetting of expectations and a change in direction where the Fed the last few years, and even longer than that, has been continued to support the market with lower rates and also directly buying assets. And we're seeing an unwinding of that. The question that we get a lot is, well, how long is this going to happen? And we do think demand is so strong out there, it's not going to end during the summer. Anyone that's out there traveling, you'll see it's packed airports and everyone wants to get out. That is a positive.
So you're saying demand is. Can you be a little bit more specific, Joe, with that?
Yeah, when we look at the market environment we're in right now, we do know the negatives out there: higher inflation, higher interest rates, and we do have geopolitical unrest, and there's some political unrest here as well.
We're in a recession. We're definitely in a bear market, but
we're in a bear market for sure. A recession, we can get in the technicality of that, and we won't know until much later, and Alex can get into details. But again, it's this slowing of the excess growth, and that's when you do have a slowdown, and that's directly correlated with what the Fed is trying to do. And we believe it's going to take some time for these markets and interest rates to settle down. We do know that the Fed is going to be very aggressive, and that's why they raised rates 75 basis points and is expected to do it again in July. What we don't know is how much longer that's going to continue. And that's when we look at the interest rates. And this is what's called the yield curve. The longer duration, meaning a longer bond that you own, you should get a higher yield. And what we're seeing right now, it's flattening. So if you look at a 3-year, a 5-year US Treasury, it's yielding the same as a 30-year. So that's telling us the bond market's not expecting rates to go, kind of above that level. And this is important to know because I think this is going to calm people down once we get at a certain level with interest rate hikes, which we could see in the next few months. Now a lot of other people are like, well, with higher inflation, this is just going to have people go bankrupt. Well, what we look at is household savings. Just how we analyze a company, we look at their cash inflow and cash outflow. If you do the same thing with most households, their income levels have gone up and wages are going up. So yes, we're seeing higher inflation. And if we start to see that inflation number head lower, which we think we're going to see it head lower, but not to that 2% rate, the Fed's saying, these are two things that can calm the market if you still have not just employment levels good, but higher wages. And that is continuing. That
Joe,
Go ahead.
Joe, let me interject a little bit. And we've had more guests join us. So Joe and I were just having a discussion on what the expectations are for the next 6 months, a year and a half, and 2 years out. And Joe was talking about consumer sentiment, how we haven't seen it this low or depressed in many, many years. But what should we expect from this, and why is the market doing what we've seen over the last 6 months? Why are we down 20% in some of the indices? We are in bear market territory. We're seeing signs of a recession. We possibly could be in a recession right now, depending upon who you talk to. Alex, let's just define what a recession is so that we can talk about that.
Yeah, absolutely. So really, there's two kinds of recessions. There's a technical recession, which is defined as 2 consecutive quarters of negative GDP. And we could be in one of those right now since the first quarter was negative. So if this quarter is negative as well, it will be a technical recession. But those are actually quite frequent and less important. A real recession is declared by a Bureau of Economists. And usually that declaration happens well after the fact. Economic data, it's heavily revised. It's really, difficult to actually define how much the economy grew. So we won't know in real time if we're in a real recession, but technical recessions are much less important and much more frequent.
Sure, and we received a chart from First Trust, and there are lots of these out there recently on recessions before and after. Just to give you some perspective, since 1948, there have been 12 recessions, and the last being the one that started in February of 2020 and ended in April of 2020. That was the pandemic recession, where the market dropped nearly 50%, and then obviously came back to where we are today. If we look out historically, if we are going to set the clock for when did this recession officially start, let's just say that it was January of 2022, and we are 5 months into this building phase for the 13th recession that's out there. The date matters. It's not that significant, but we are in this period where we've experienced negative GDP growth in the first quarter, and subsequently in the second quarter, coming up, we could experience another negative GDP quarter. So technically, we are in that recession period. You should also know that 6 months before a recession starts, the market trades in a very a narrow range. And you can look at the information that we can send you, and it's between 1% and down 10%. But during the recession, we should expect another trading range where we're not going to have a lot of advancement in the market, but a trading range following a recession, the first year following a recession, and the 3 years following, and the 5 years following a recession, you can see measurable gains in the market. And that will be a part of the focus of our discussion today is what is the outlook? What is our outlook and what to expect? I'm going to shift back over to Joe and start talking about our outlook that we have.
Yeah, and before we go on there, what I kind of look at is where we're at. After a 23% drop, it's good to know stocks fall about a median of 24%. And this is in recession since World War II. So we're there already. And I think that's important. When you look forward, you got to look backwards and where we're at now. We've already had the market sell off, and we know the market is 6 months looking ahead. So when we start looking forward, our leading indicators, which still remain positive, they are not signaling a recession. And this is for a real recession. It's just not showing that yet. And you also don't get wages and employment at this level and continuing to go up. So, we can talk about, are we in one or not? That's a discussion. But we did have a over 20% drop in the market. So looking forward, I think we need to see some positive with two things. One, it's getting inflation under control. And I think that will then help interest rates cool off, and that'll allow the Fed to not keep being so hawkish with raising rates going forward. If they can do that, you can then get the positive of those unknowns out of the way, and we can get back to what the market focuses in on, and that is corporate earnings. So we can talk all about everything that's happening right now, but what is happening to earnings? Now, earnings estimates, we said in the beginning of the year to expect volatility, and we definitely got that. We also expected to see, again, some profit taking, but also change a little bit in leadership with higher interest rates. And that's exactly what we got as well. We did position our portfolios to have inflation, obviously not at these levels, but that's where we overweighted some sectors. So there are things that we did do. And going forward, again, I think that you have not seen earnings estimates, and this is not just for 2022, it's 2023. And that's what we have to remind ourselves. Earnings have continued to go up. And we're not having that growth we had last year of 20 to 40%. We expected to have high single digits. And so far with earnings, companies are beating their estimates, and we're starting to see some estimates come down. And that's why the market is trading lower. It's expecting earnings revisions to be lower. But what's interesting is they're not coming down as much as I think people think, and that's helping with valuations. So you had a couple of companies recently report, and this is important because next month is the next quarterly earnings, and we'll get confessions from the companies to see how they're doing. We know the U.S. consumer continues to be strong. That is helping the global markets. Anyone traveling overseas, you see how strong the U.S. dollar is. It helps you buy much more goods when you travel overseas. Internally, that's helping our markets because you're getting more capital coming in. But when the United States, raises interest rates, this has a direct effect on the global economy. Anyone that's lending is going to start, or borrowing is going to have to pay more in interest. And that is a negative out there. But then you look at historical levels, having interest rates at 3.5%, that's still historically low by any standard. And again, that's where I think the market's trying to reset expectations and where are we going to go from here. So it's going to take some time, I think, for the growth to come back in because we do need to see a few things settle down. And that's where you get these choppy markets. This is what we've seen this whole year. We can go back to March. In a bear market, you have the markets drift lower, and then you get these violent upswings. And this is, including today, the third time that we've had, these violent upswings. So I think that's what we mean by choppy and volatile. Volatility doesn't mean it just goes down. You do have the upswings as well. So that's what we're kind of expecting until we get some certainty with a few things that we mentioned before.
So we can debate recession, no recession until we're blue in the face. But the portfolios that of everybody on this call are down anywhere from 15% to 30%, depending upon whether you're a growth investor or you're a value investor. Alex, I'm going to ask you a specific question. The S&P is off 20%.
A little bit more.
A little bit more. The strategy asset manager portfolios that are worldwide equity and our balanced account and our dividend plus are outperforming significantly on than that overall return. That's a positive that I'm kind of throwing in for strategy asset managers. But the question that people are wondering is, why are we off? Why are we off so much in such a short period of time? And what is the market signaling? What is the market signaling by being off 20% to 25%? And then when are we going to see some type of turnaround?
So with the first question, I mean, why are the markets down? It's, again, I like to go backwards to look, and you can see the markets did tremendously well when the Fed was doing what? Lowering interest rates and allowing liquidity to be very strong, and that bid up assets.
We had a lot of stimulus during that period of time.
Correct.
Right?
And that's lowering interest rates.
M2, the money supply grew in extraordinary levels.
Yeah, and you hear a lot of people talk about that. When I just say accommodative, I'm just including both of them, but it's lowering interest rates and then looking at the money supply. And what we're doing now is trying to raise interest rates, but it also has to do an effect with reducing the monetary supply as well. And that's hard to do. And that's really hard to do without having a recession. So, we will keep a looking on that, but it's also, that's why the markets have, dropped so much. Its borrowing costs have gone up, and that usually hurts the companies that are most growth oriented. And you've seen that excess, and that's what recessions, or when you have these significant tightening policies, are doing. They're removing the excess from the market. Now, I did not expect the Fed to be this aggressive, and they are. And they're going to front load it, meaning they're going to try and do big rate hikes as they've done last month, this month, and potentially next month. And that'll allow them not to be able to do rates going forward. So that's what you have to look at when we see where rates are at and what's the Fed policy going forward.
Well, the the Federal Reserve is late. Let's just say it, that they've addressed the issue too late, and we're in this situation on today's date, June 21st, where they aggressively hiked rates 75 basis points. It did surprise the market. We know that we need additional rate increases to dampen inflation, and we won't know until several quarters ahead whether the actions that they committed to were positive. But we're in where we are now, going back to the question of the market being forward-looking, Joe and Alex, how long do you think this correction is going to last?
Yeah, that's a good question. And I'll look back at history. It could be a couple of months. It could be, longer than that. It could be a year. And the big unknown is, once people feel comfortable again and we get some stability with, I think, interest rates and inflation, that could be a turnaround that we could see happen sooner than later. And again,
especially if the war were to end, we could see a really, really rapid decline in oil prices and, a commensurate decline in the rate of inflation. The break even for oil, according to shale CEOs, is around $70 a barrel. And right now, oil's trading, 115, 120. So if the war were to end, we would see oil prices rapidly move down nearer to that break even, which is where they should be from an economic perspective.
Let's talk. Also, a good point, Tom. A good point that Alex mentioned. It's also with oil, we have to remember what's happening in Russia and who it's benefiting from. So China is buying Russian oil at, what did you say, Alex? $80 a barrel, 75? That's a significant reduction. And why I mention that, because China's just opening up. We've had global supply disruptions continue with China being locked down. As they open, you're going to get these disruptions, cleared up. That's going to help inventory levels, and that's going to help, again, corporations be able to shift faster to meet demand. So those are some things that are positive looking if we get those. Again, it's COVID is still here and alive and well, unfortunately, and that is causing disruptions. Now, with time, like we saw in the Spanish flu, we've mentioned this before, it was 2 years to the date, and people started getting out again. And that's a similarity that we can see. And what happened after that? You had the Roaring 20s. And again, this is important because technology moves forward. And we have to remember everything that we did with COVID, we were able to work remotely. We're able to communicate. We're able to shop online. And those trends do not go away. They are just going to continue. And that's, again, a positive that we have to look at. Things change, yes, but it's also the accelerated change is fast. And that's what gets people unnervous when you just don't know how this is going to play out. So I do see positives out there and why this market can continue to go higher.
Joe? But Alex, you've got some prepared comments also that you wanted to make, and I would like to shift a little bit and then come back to some of the questions that we have about interest rates, timing, and also what to expect. Alex, do you have some?
Sure. So I think whenever we have a bear market, and this is the third bear market since 2018. It's really important to take a step back and look at things from a high level. Every bear market in American history has eventually been recovered. Every recession in American history has ended and been followed by an expansion. It's completely natural for the economy and the market to have ups and downs. It's nothing to panic over, really nothing that we haven't seen many, many times in the past. This is the fifth time oil has spiked like this. Every time, the forces of supply and demand helped it to normalize. And that's, eventually what we can expect here as well. These forces, they don't work overnight, but they do work. And we can expect them to work this time as well.
Well, what are we doing to prepare for this? We talked about this morning on our research call. What was done in advance of this, Joe? Because we were beating ourselves up on our research calls for the last several weeks, and for some reason we brought this up today. Our sector shifts and our strategy shift happened well before January, but it doesn't get brought to the attention of our group because this was done in advance, because we anticipated we anticipated a shift from growth to value and sector slowing in certain areas. Joe, you want to comment on that?
Yeah, and it's the two areas. It's really energy and materials. These are areas that we've put money into last year and added to again this year, and that happens to be some of the best performing areas of the market. And it wasn't because we had any information. We did expect, again, these were very good value plays, and we thought energy wasn't going to stay at negative numbers. We didn't expect it to go this high, but those represented, again, looking at the market cycle, some good areas to be invested into. Conversely, you have to remember most of the performance in the market is going to be by the sector, and technologies led the markets for almost 10 years. Discretionary did tremendous as well. These are market cycles that happen. And before that, energy had done substantially well. So we're just seeing, again, kind of the smoothing out of the sector rotation and what some things are doing well.
So what should we expect over the next a couple of quarters? What are the standout areas that that you anticipate?
Yeah, I think I know having outperformance, it's still negative numbers. I get it. We understand
Correct.
The frustrations, but I do think with our bonds, we've done a tremendous job, and a lot of our clients have bonds that are coming due now, and we have been, and we're, again, bond market was down as well this year if you look at bond funds. So getting people to own individual bonds, you're now able to get close to a 3% depending on how far out you go. So I think that's been a tremendous, again, just a place to hide money for the short term, because you have got interest rates substantially higher. And now your money markets are going to yield maybe a couple more pennies as opposed to half a penny. But again, that's one positive, is that you are seeing savings rates go up a little bit.
Let's talk a little bit about, because we've only got a couple more minutes. We've already been on for 30 minutes. We're reacting on our research calls to the hyperinflation. The energy markets have been impacted, and we've seen the price of gas here in California above, in certain areas, $7.50. Our clients that came in the office today from St. Louis, Missouri, they're paying $5. So there's a significant difference. A lot of that has to do with the gas tax that's out here. But interest rates are going to continue to go higher, and we are going to try to combat inflation. Let's go back to that point, Joe, and talk about, or Alex, talk about the expectation for rate hikes going forward, and how that should impact inflation, and what type of data are we seeing that is showing signs that inflation is dampening.
Yeah,
I think the
Alex.
inventories, especially the retail inventories, are just incredible. Over the last 8 months, it's been not only the largest in the history of America by far, but really orders of magnitude greater. So if you're looking to buy an appliance, some clothes, you should, really prepare to get a really, really amazing deal. And you might even want to wait on those purchases for a couple months, because these retailers are going to be forced to liquidate at just incredibly great prices for the consumer. We're seeing inventories up 40% from last year at these major retailers. Again, this is totally unheard of, and it's going to have to be worked off. And that's going to be, a force helping to dampen the rate of inflation.
Yeah, and I think that's important to remember. These big, we call them the retail box companies, they couldn't really pick and choose what inventory they were getting, because they had to pre-order it so far in advance because of the supply disruptions. What happened? You had people that were no longer staying inside. They weren't just buying TVs, couches. They wanted to go outside and have an experience. So what happened to all these big retailers? They had too many TVs and not enough luggage. And luggage has been selling off the markets. So it's those kind of shifts that we've seen dramatically. And again, for the consumer, you're going to see, again, go to any of the big retailers. They have excess inventory, like Alex said, and they're going to get rid of it. And that's going to take a few, maybe a quarter or two before we get that out.
Yep.
But again, the positive is supply chains will start coming back up, and they'll help those companies manage inventories better.
So if we're lucky enough to have the disposable income to be able to go out and buy, a new appliance or to take advantage of the excess inventory, that's wonderful. But if I'm on a fixed income, and my portfolio just dropped 25%, and I just retired, as some of our clients who are on the call just did, I would like to be reassured that we are not sinking further down. Do you expect any further declines in the market, Joe and Alex? Joe first.
Yeah, and again, I said the median drop is about 24%. And we basically hit that number. I do look back at historical numbers, and can we see a 37% pullback? We could, but we
did last year. We saw a 50% pullback.
Yeah, we had a 35% pullback in 2020. But going forward, that was, again, the big crucial difference for me. This is not 2008, because this is not a global financial crisis. It was a loss of confidence in our economy and financial instruments. This is not 2020, where we had a government shutdown. Yes, every bear market recession is different, but you're not seeing, I don't think the government will be able to shut down. That's number one. And number two, when we look at the banks and the financial crisis that we saw in 2008, it's a completely different picture. And that's what someone just asked about the housing market. We go look back at then, and we all remember the ninja loans: no income, no job, no assets. You were able to get a loan. You don't have that now. All of these mortgages are very much more well documented, and you have cash flow. So, you're in a much different situation then. And that's part of the reason why the Fed's raising rates as aggressive as they are. So just some things to keep in mind.
Yeah. So more than likely, the majority of the people who are participating on this call took advantage of refinancing if they had a loan to a lower fixed rate within the last 3 years, maybe 5 years. For those of us like myself who just bought a house, I was subject to the current interest rate environment. But as my father reminded me, and several other people have reminded me, these are still very low interest rates. They're still very low interest rates. What will happen to the lack of inventory for the housing market and the housing market in general is a question that gets brought up, as we just answered. We do know that in these business cycles, when interest rates remain low, it is more attractive to own than rent. That occurred over the last several years. And those people who were renting shifted into owning a home. However, the inventory for homes started to dry up, and we are now in a period where there is not enough supply to meet the demand. Alex can talk about that a little bit because it does interest a lot of people. What is going to happen in the housing market, as we just talked about? Let's expand on it a little bit, Alex.
Yeah. So, like in the short term, obviously higher rates is negative, but I would point out that, house prices rose 20% last year. That's not, that's overheating. That's not what we want. We want that to get down to a more reasonable 5 to 8% range.
Yeah, what was the normal during, the 50s, 60s, 70s? It was, it was a CPI adjustment, maybe 3 to 5% growth rate, and then
closer to
Yeah.
the rate of inflation, right? Like it shouldn't be 20, and this is part of that natural process whereby the economy normalizes itself, right? House prices went up too fast. Now they're going to go up a little bit less fast. That's hopefully going to flow through to inflation. But it's not some kind of catastrophe. And in fact, if you look at the demographics of America, housing looks really solid over the next 5 to 10 years, simply because the millennial generation, which is the largest generation in the history of America, is now entering its peak home buying years. So it's going to have that force underpinning the market. So I wouldn't foresee any, sort of disaster in the housing market, just a natural moderation, which is a good thing.
I would agree. I would agree with that. There is a shortage of new homes out there. There is a desire to own a home. Interest rates are low. They are increasing, but they still are historically low. So we do not see a major correction coming or looming in the housing market. Let's shift over a little bit with some of the we talked about the headwinds of rising inflation. We talked about and where is inflation right now, Alex? We're just under 10%.
So including energy and food, it's 8.6. Excluding energy and food, which is called core inflation, it's 6.0.
Right, and I think that the Federal Reserve mandate is to come back somewhere between the 4% level. Is that about right, Alex?
Yeah, so they've been undershooting inflation for such a long period of time that they might even, be okay with overshooting it. But yeah, definitely down, lower to that, 3-4%.
Right. Okay. It's good to keep that into perspective. We do have some headwinds, and the recession that we're experiencing or heading into does have the Federal Reserve trying to dampen that inflation, as we've talked about on the call. Let's talk about the Russia-Ukraine situation once again, and just comment on what could happen if there is talks of peace, and what could happen if it's just prolonged. Alex?
Yeah, so the chief impact, and really the only impact, is on oil and food prices. Russia is basically, from an economic perspective, insignificant, with the exception of oil and food. So if the war were to end, we'd see a rapid reduction in the prices of oil and food, which both inflated as a result of the war, and sort of vice versa. If things were to escalate, then we could see, a further increase in the short term.
Joe, do you have any comment on that?
Yeah, this is where we have good discussions on this, because I just think the war is going to continue, and you need to have that positive view, but it's also the realistic view until the two sides, which are completely apart. I just don't see that ending anytime soon, which makes inflation still run hot, but it doesn't have to be at this 8% level. We could see it cool down just as normal supply disruptions get replaced. And what's interesting, Germany is now, they're much more green, I guess, than the United States, and they're firing up their old dirty coal plants. So again, there's a certain dollar amount that hits you where you need to get those prices lower. It's the old saying, it's the economy, stupid, and you need to make prices go lower. So you're seeing that overseas. They are, if you're not going to do this, you're going to get voted out. And we saw that with some of the early elections. And again, I think in the short term, you're going to get a little bit of people looking to save money and also firing up, energy independence, which bodes well for the United States.
Oh yeah, and the other side effect of the war is that it's driving capital from both Europe and China into the United States. And you might say, well, what does it have to do with China? Well, a lot of foreign investors are scared that the same thing that Russia did will be done by China, that one day they'll wake up and they'll have invaded Taiwan and every penny you put into China just went to zero, right? So that fear, that geopolitical fear, is causing foreigners to be very, very wary of Chinese investments, because you don't know what they're going to do, and you have to consider the possibility that you'll lose everything. So it's really strengthening the dollar a lot, because America's just so much safer, so much more solid.
Yeah, you should all know that we watch the geopolitical events very closely, and we take that into consideration with the macroeconomic outlook that we have. It's a big what if there are peace talks coming. Hopefully, cooler heads will prevail. It's been a terrible situation. But definitely down the road, that Alex brought this up this morning, that we eventually will see a peace at some point, and there have been discussions that have been happening for the last 3 months about the timing of that, and very important for the potential for that to be a player in helping accelerate the recovery of the recession that we're in. Let's go over to some of the positives. I like to end on a positive rather than the negatives that are out there. Joe, let's talk about the positives for a few minutes.
Yeah, I mean, one thing we kind of overlooked so far is what happens if we actually get some agreements this is the United States, with maybe doing away with a holiday for gas tax. What happens if they actually come to agreement with China and lowering some of the tariffs? These are things that can lower prices as well and increase production. So those are a few things that are, just getting talked about with the elections, midterms coming up in a few months. You're going to hear more of that. But again, some of the positives, we keep harping on this. The U.S. consumer is the engine for our economy. And we continue to see the consumer spend. And that is helping not just household savings, but it's helping the global markets as well. And for me, that's the big thing. We have seen a shift, just like a shift, people from leaving California to going to Dallas. Dallas is booming. Texas is gigantic and just continues to attract people. So, you have to look at the big picture. And yes, there's some negatives here, but then where are the offsets and the positives? And I think as long as the consumer spends, we continue to see, the employment numbers where they're at. It's a pretty powerful economy that we have with both production. Inventory levels are high, and that's going to take some time to reset. But again, you've got a lot of good things that are happening, and that can still happen on a positive note.
Yeah, so we're in a much different economic position entering into this recession than we were in 2007 through 2009. We remarked on it this morning about the health of the banks, the banking system, the resilience of the consumer. Is that right, Joe?
Excuse me, I was coughing.
Yeah, that's
yes,
okay.
You're absolutely correct. And
I thought I caught you off guard, and you're like stumped by my question.
Great question.
The after effects of COVID brain.
Yeah. So it's one thing to really keep in mind is the banks, household savings. These are things that we do keep an eye on regularly. And the monthly comes out data on like American Express, JP Morgan, Chase, all the credit cards. And what you typically see is delinquencies. And this is when we can look at like high yield spreads. You start seeing deterioration or or just more people not paying their bills. And we have not seen any of that happen in any material way. So that's one sign that you'll start seeing before. And why is that? Well, we talked about housing, and I think this is important. Mortgages aren't what they were in 2008. You actually had to put money down. And again, when you lock in a low interest rate, your payment's not going up, so that's kind of a positive for your house. You're not going to have to pay more. It's the new people going in. So that may get more people to stay in their existing home right now. But again, I think that's a pillar of strength right now. Households and also companies. We were jokingly looking at Facebook and Google, the two stocks. Well, Facebook's now Meta, but those companies are now trading like a value company. And the cash flow that these companies have is still very strong. And again, I think that's the resetting of expectations and just some things to keep an eye on going forward. It's a much different system or state we are in right now versus 2008. Again, it's the cash flow, balance sheets are much better. And again, I think that's something that doesn't just change overnight. It's going to take a couple of quarters if you were to see deterioration.
Right.
And that's, again, just have some calmness when we look at the day-to-day numbers, because we know what's news organizations supposed to do. They will have a soundbite and they got to give you something to get hooked on it. And again, I think you don't hear all this other positives that we see.
Yeah, we're definitely not in a great period right now for market returns. Essentially, all of the gains from last year have been given back. But as we look forward, if the Federal Reserve eventually gets monetary policy tight enough to bring inflation down to the 2% target, that will probably not happen this year, more likely next year. We could see another bull market happen. That's opportunistic. That's also very optimistic. But we also have to, as Joe said, when we're in this period of digesting the medicine that is being, or accepting all of the procedures that are being put into place to temper the severity of the recession, the markets are forward looking. And Joe, you should remind everybody that the market projects out 6 months in advance, correct?
Yeah, and it's also in this uncertain time, it's also good to know what is good to own, and it's dividend-paying stocks. These are companies where the yields are now close to 3%, some a little above that. And again, that's the equivalent of what the bond market's getting, and yes, you're going to get the volatility of the stock market, but I think that's been a safer place, more defensive, and then a lot of the growth areas that have been. And I expect that to continue in the short term.
Okay. Alex, do you have any closing comments to make?
No, just, generally, technological progress drives the economy forward over long periods of time. Everything that is negative is short term, and all of that stuff will eventually fade away. You always have that wind at your back because our civilization's been trending upwards for 300 years. And it's likely to continue.
In an inflationary market, it's better to own equities. Is that right, Joe?
Yeah, that's kind of when you have inflation, what do you want to own? You want to own hard assets. You want to own assets that can appreciate in price, and that also have pricing power. Those are the types of companies that you want to own. And yes, you do want to own stocks when you have inflation. This is just you have to look at longer term horizons, but you have to be able to, again, navigate the sectors and what places to go into, but also who has pricing power, who can pass on that higher price to the consumer. And those are things that we'll see, in the next, few years for sure.
Yeah. We have some time to go, to get through, this very challenging market environment. However, the future does look very, very bright with all the innovation and the entrepreneurship, and also what we've learned from the past. And as I said before, we've had 12 recessions since 1948 to 2020 that we've recovered from. The 13th is the one that we are in now, unlucky number 13. However, as Alex said, and as history has shown, there will be a period that we start to recover from it, which is now. We don't know how long it will take. It will probably be shorter than the expectation that's out there. But we do know that historically, 1 year, 3 years, and 5 years, as Warren Buffett started buying equities about a month ago, and it came into the Wall Street Journal, he said, what I'm buying today will be worth a lot more in 5 years. I'll end on that note, and I want to thank everybody for joining us today. We're going to try to stay positive, and we'll be back in touch next month with an outlook at the end of the second quarter. If you have any questions for us or your advisors, please feel free to reach out to us directly. We're obviously very accessible. We hope you have a wonderful summer and a July 4th holiday weekend coming up. Thank you, everybody.